Welcome back to Giving You More Than Numbers, the CAS Business Support Podcast. I'm Paul Barnes, and today we're talking about tax, but please don't switch off. This isn't about loopholes or scare tactics. It's about calm, steady planning, the kind that helps you feel in control. Joining me are Rob Boland from Cotswold Independent Financial Advisors and Dan Chadwick from Mercia Wealth Management. And together, we're breaking down the difference between tax planning and tax fixing, the quiet decisions that reduce tax over time, and why the best tax strategy usually starts much earlier than most people realise. Hi guys, thank you for taking the time out of what is a very busy schedule. Obviously the opening intro was one of tax planning, tax fixing. What does that actually mean?
I think for me it's more about, people see like tax fixing is more very last minute, help me, what do I do? Tax planning is that 12-month long, right, okay, here's the situation now, here's what the situation could be in 12 months, what do we do to be as most efficient as possible with it, I would say.
Yeah, so it's that forward planning piece.
Yeah, I'd say a lot of people get hit up twice a year when the Chancellor gets up to speak, and invariably will change the whole planning that we've maybe put in place for years gone by. So it is that constant conversation. I think our role is to take those tax rules and see what we can do to sort of suit the client's objectives.
Yeah, and let's be perfectly frank, across all of this, can we mitigate as much tax and put as much money in all of our clients' pockets? And actually, because we should all be tax planning ourselves, in our pockets as well. So why is there this constant last minute panic to beat ISA cut-offs and that, when reality says business owners should be planning in advance? Is it naivety, lack of knowledge, lack of foresight, lack of a real idea on actually what does it mean?
I personally think it comes down to probably a little bit of education as well. And this goes back quite a few generations. We've always been built to have to be reminded that there is a deadline looming. So a lot of clients will just park it for the last minute. Whereas, of course, if you're having the conversations constantly, the idea is if you are late to the tax year, you're going to be early to the next one. And you're going to get your planning in order. So for me, it is education. We have to educate clients. We have to educate the public on why tax is a year-long process, not 2 weeks before the deadline.
And I think that's the key. I think it's that giving people those insights to go, you can start doing, we can start thinking. So let's assume that and try and make this a little bit real for people tuning in. Let's assume that you are meeting somebody that is really proactive and is at the start of, I'm going to call it a tax planning journey, because it doesn't have to be at a set point in time. What would that initial piece kind of look like? So not necessarily how do we sell what we do, but what type of things should they be thinking are available to them on day one of a tax planning journey? Dan?
Well, I guess for me, again, everyone's approach can be different. Mine's always been, if yours is different, tell me. What they want to get out of it. What do they want to achieve in the next 12 months?
So their end goal.
What is their end goal, both in the future, but also the next 12 months? So we can then start putting a plan in place to help achieve that as well. Because it's very easy for someone to come up to you and say, I want to save money on tax. Why? Why is that important to you? What's the reasons behind it? What's more like that psychological reason why you want to do it? Is it a case of you just want to spend it on some fancy new equipment? Or is actually a reason long term why you want to do that?
And I think that brings us probably nicely into, I suppose, that little bit of a nuance and a difference between us as accountants and you as IFAs. Our first thought is mitigate tax, both corporate and to a certain extent personal tax. Yours is actually about making that money work for them. And one of the first sort of things that we ask clients, have you got an IFA, when we kind of go through probably our first, whether it's quarterly review or pre-year-end tax planning. But actually, more importantly than that, do you have a pension? Because that's one of the ones that we can support them with, but actually that's where you guys then come in. And it is, what you can deliver that we can't and shouldn't. So if we talk about an accountant's pre-year-end tax planning meeting, that is always about the capital infrastructure, the pension pots, things like deferred payments, work in progress, the bits that affect them now. But though, what other things are available from a planning perspective that you guys can then suggest that they start to look at and do that we as accountants don't do? Because I think that's really useful.
Yeah, and I think very similar to Dan, I think it is a very objective led. I think we have to meet the client. We have to understand what they are trying to achieve, both in their business, both in their and their personal life as well, because that's going to dictate what sort of tax reliefs we can use for them across the products that we're going to maybe eventually recommend to them. Pensions a very big one. Obviously, there are personal reliefs, but there are some great reliefs for a business owner. ISAs, more on the personal point, but there are protections for their family. There are all of these wider things that maybe an accountant wouldn't necessarily know to recommend, but it is important to them. I think a lot of business owners forget that they would have had these benefits as a PAYE.
Yeah.
So sometimes they forget about life insurance, the sick pay. So that meeting is really the first establishment of what is important to you, what's important to your family, what's important to your benefits that you give to your employees, and really understand where we can take things from there.
Yeah, and I think that similarity of what's the end goal for a client is the same conversation that you have that we would have in terms of where is this business going, what's your exit point, and what are you going to do then? And so that's probably the only similarity we ever come across, because you're looking on a slightly different tangent. So just to wrap up what would be section 1, can either of you, and I'm happy for 2, walk us through an example of what that 12-month cycle looks like from somebody, and let's use a tax year as an example. So let's not do last minute panic. Let's go. They've decided 6th of April. Let's not do the 1st of April. The 6th of April, I'm going to engage in IFA. What does that journey look like for them right the way through to then the 5th of April the following year? Just to give us an idea on the type of things they can be expecting that add that value.
Rock, paper, scissors. Who goes first?
Rock, paper, scissors is fine by me.
An interesting concept for a podcast. I think, again, if I was meeting you on the 6th of April, we're going to conduct a very thorough fact-find process to understand what position you're in. So we're going to understand what assets you have available to invest. We're going to probably be working on your income and your expenditure on a monthly basis to understand what type of budgets we've got for all these products that we might want to recommend. We're going to identify quite a lot of shortfalls. So I think front end of the tax year, we're going to be quite heavy loaded on understanding what's important to you and your family. And then from there, if we're doing regular contributions, which will have a massive benefit in themselves, we're going to obviously start to look at that budget of what can you afford to set aside monthly. If you've got lump sums, is there any previous carry forwards from tax years you've not used?
Yeah.
So that first meeting is going to dictate probably the rest of the tax year.
Yeah.
Because we'll know from there where we're going.
Yeah. And Dan, if in that same kind of scenario, I'm not saying you work differently, because I would imagine you're pretty much guided by the FCA. But if somebody says, I've got a limited budget, what would be, if you like, top of the list? And I'm not saying that you ever hard sell or anything, but what would be those top couple where budgets are limited that add the biggest, whether it's value or a surety that they've got what they need in the short term?
If they've got a limited budget, it really does come down to them, because every person, different age range, different family circles, they're all going to be different.
Yeah.
So it really does, like Rob was saying, depend on that first meeting, what they have got at the moment, what is their future plans, things like that. What's been their previous experiences as well? That's going to be important. And based upon that, we'll then have an idea in our head as the meeting's going on. Okay, this should be important. However, actually, this is now like pension might, if they're younger, pension might not be as important.
Yeah.
An ISA or something like that might be even more. Looking at investing might be more important. If they've had just had a family, well, actually, then protection becomes the most important. So everyone's different. So
all about circumstance
Yeah.
rather than actually, here's our list of the top 10 products, and actually that's the order we have them in. Very, very, very bespoke.
I find, I don't know if you find this as well, people get mixed signals by it because of social media influencers, where they will say, no, you must do this, everyone should do this. I saw one the other day that's caused an uproar on Instagram saying workplace pensions are a scam. Again, everything's all relative to every single person's different, so the solution's always going to be different. And that,
get it.
So it's not a one size fits all.
But I think there's a lot of conversations I've had with younger clients that are limited companies that come to me and looking to throw quite a large amount into a pension sometimes, and my advice often is, why are you chucking quite a large amount into a pension? So it's really understanding, number one, what the tax bill they are trying to mitigate, but also as a younger person, why they would want to commit money to a pension where they might not be able to access it for some years to come. So it really is a case of, and I always liken it to education, we are there to try and educate the client and support them in their planning. And the social media side scares me. I mean, we post on social media, but we're a very controlled environment when we.
And I guess you've got, I guess, a certain criteria that you are allowed to post, so it becomes more trusted. I think would probably be the phrase.
You'd like to think so.
I hope so.
Because of the FCA, you have so much red tape on what you can say. An influencer can literally go online and say, "Oh, quickly invest in this. Just do it. You're going to make lots of money." Someone will see that versus a financial advisor, where they'd say, "Look, everyone's different. Recommend we have a meeting, things like that. We've not even answered to invest." So sometimes they will just.
I think there's a carefulness, like Dan was saying. We are bound by rules, which is for the right reasons. We are bound by those rules for the purpose of giving you the best advice that we can give you. But the difference is, I think anyone that posts from our background is likely to try and point you to come and have a conversation so we can actually iron it out properly, rather than just hearing what, like Dan's example of workplace. So why is that a scam? Why is that so negative? Because
I wanted to comment so badly.
My opinion is any pension is generally good for the client. So there's got to be a reason and a background behind that.
Okay, so obviously, I think what's come across is go and talk to an IFA and have those conversations, because they can steer you in the right direction on what's right for you. So let's assume that a client has come to you, you've had that initial, and I know we have to be careful with what you can and can't commit on this, but we're having those conversations. What sort of decisions can you have with them that help them reduce their tax burden over time? Not in big ways, so not that big pension chunk, but actually don't compromise them in terms of tying loads of money up in lots of things that it's difficult then to release if they ever needed to. What sort of decisions?
Said stuff, I was like, "There's no way I can answer this." I was like,
what smaller decisions can affect and have a bigger effect on reducing that tax over time?
Are we talking them as like a personal situation?
Yeah, personal. Let's deal with the personal situations.
That's where it gets tricky, because it comes down to what we proved, where that whole fact find meeting is so important. To then lay the groundwork of what they've got, what allowances have they got available to them, what have they used, what have they not used, and then it is a case of just starting early and within their budget as well. I've come across, I don't know about yourself, so many times where a client has gone to you from a previous advisor and they're literally scrounging to afford all these regulars, and you're like, that doesn't align with what you're telling me what your goals are. So it's literally taking it back to see what they're comfortable with.
Okay.
I think we have to challenge clients a lot more, because again, I've been in the profession 20 years, and I've never seen a client fully give me an expenditure which I fully trust is reflective of what they do spend. We used to.
Says you got £1,000 left over.
Yeah, they like rounding up and rounding down at times, but actually they forget to eat sometimes, according to the expenditure spreadsheets I get through. So it is that challenging point, and I think the way we can add value in tax reliefs is understanding what they can commit and whether that is affordable. Any regular premium for life insurance, pensions, I would hate for someone to start a contract to not be able to finish that contract. Yeah. So it's having that sensible conversation about affordability sometimes. Look, don't get me wrong, we would all love to mitigate as much tax as possible, but we also have to live a life and we also have to be able to come to
and let's be perfect, we're going to have to pay tax somewhere down the line, and it's just about when we do it and can we do it in the most tax efficient way.
Yeah, it is that whole efficiency and affordability part that's most important.
Yeah. So I know we can't talk specifics, and I feel like we've got
That's
a bit.
Why I was so shocked when he said about doing a podcast. I was like, do you realise we're literally?
We will try. We will try.
Yeah.
We will be fine. So we've spoken about pensions, and the typical thing from an accountant is actually, let's look at your profits at the end of the year, and we know we can push up to £60,000 into a personal pension. Is that the smartest way for somebody during the year that is making consistent profits to grow their pot?
Paul wants to get us in trouble. I love how he's teetering us on
You're
this
now
line.
giving us amounts. Now, what you're doing is you're throwing amounts in and you're trying to throw some
We've
out.
literally got compliance meetings in the back of our heads thinking,
I'm actually, okay, let me split it up. Is it better to pay 60 grand in once a year, or be able to spread that across a year, thinking about a way a pension pot grows?
It really varies on the business and the client that you're talking to. If they have just such an extreme amount is the business account, where doing that 60,000 lump sum isn't going to make much of a difference to like their cash flow, because at the end of the day is the most important thing is the cash flow. That's fine. Some prefer just the once a year. I just want to get it done and not think about it for the year, rather than the whole monthly. Whereas other businesses, they just prefer that monthly because it doesn't affect how much they have in the business account. Because some of them have a certain amount where they just want to see that amount. Let's say, for example, 50,000. As long as they see that amount, they're comfortable with it. Just sitting there in the bank account. So I would say it's a tricky one.
So it's very difficult because, again, pound cost averaging is the common one that you would benefit from on a regular premium. Now, if you're a business owner and you can commit to the same amount every single month, then fantastic. That would probably work in your favour. But a lot of businesses I deal with will leave it very last minute, as we talked about, and then want to chuck a lump sum in when they know what they have achieved over the year. There's no other costs, so they can commit to it. So again, without trying to give you the very easy answer that it will depend on the client, I think we have to have that conversation to understand, is it possible to do regular? Again, if we did regular, it would answer probably the first section of what we've talked about today about proper tax year planning.
And I guess it was, without trying to get anybody into trouble.
That's fine. Can I just add to that as well?
Yeah, no.
Sorry. That's the benefit as well for carry forward as well. So even if they do leave it too late and can't do such a huge amount, we can always go back previous years as well. Yes, it's never, not that it's ever too late, but sometimes.
I guess where I was coming from, because we hear so much around things like the compound effect, and if everything was equal and you could do, and I'll just pluck a simple number because I can do the maths, £12,000 a year, I kind of assumed that the compound effect of £1,000 a month would give me a better return over a 1 year period than chucking it in once at the end of the year. And I guess that's where I was going at, was to try and see whether as business owners or as individuals, can I contribute, and is there a benefit to contributing more regularly if my circumstances allow, instead of doing it just once a year to grab that tax efficiency?
Well, I think I'd throw it back to the pound cost averaging, and to use a recent example, as we're recording today, obviously the markets are suffering a little bit in these last few weeks. So of course your contribution this month will probably get those assets at a cheaper value. So therefore, you would benefit from it that way. But there are going to be conversely some months where you're buying at a much higher price when the markets go up. So without going back to sort of trying to cover ourselves here a little bit, there will be a dependent on that. But I think regular commitments are shown to be the best way sometimes, and also for budgeting and various reasons. If you can afford to do that, you can afford to split the 60,000 between 12 months. It would be fantastic. I've not met many that are able to commit to that way or want to commit to that, and it sometimes is a want. Because it seems a high amount.
But I guess then people can actually go, and it comes back to what you were saying, I can afford this per month with the opportunity, having sat down with accountants and their IFA and go, actually, I can then put in a little bit more if circumstances allow.
Towards tax year end and things like that, once you've had, and this is what I always push back on clients, once you've had that conversation with the accountant. So many times I've had it where they'll be like, I can afford X amount. By the time you've actually pushed them and had a meeting with the accountant, they've been a little bit optimistic. It's going to massively affect their cash flow.
There's a lot of clients that don't make probably enough, of a tax burden for you to benefit from that contribution as well. And that's the genuine conversation. One of my clients, we work with their accountant very closely, and they actually threw it back and said, well, we can do this out of the business, but there is scope for a personal contribution, which will actually help her in that way. So you've just got to work between the two sometimes. And I think the relationship is key between the accountant and the IFA for that reason.
Absolutely.
That's the bit I think that's most important. The clients that actually liaise with both the financial advisor and the accountant, they 9 times out of 10 benefit way more often rather than the client that's, I'll talk to my advisor. I'll talk to my accountant at some point. And they always forget, whereas the ones that have that group actual meeting, they always seem to benefit the most.
And again, I think something that's come through all of the podcasts that we've done so far is one of communication is absolutely key. So I guess actually it's small gestures where affordable can have over time a bigger impact than one big hit sporadically. Where possible. Fab. So
sorry, mate.
No. But I think it's important because actually, when people are looking to try and make these decisions of what should I do and how should I do it, they're better informed because I'm asking questions and people. And if you gave me straight answers, people can go off and do it off their own. What's coming constantly through this is, however much we want to give answers, we need to understand what their position is personally and in their business before you can actually give that advice that is fundamentally going to affect them in whatever their future looks like.
Well, I think the danger is if you take, what the man down the pub, well, I don't think people do that anymore, take the advice of man down the pub because it's TikTok and Instagram now. But if you take that advice on as that's the way I've got to go, Bitcoin is a great example of that. Let's throw all our money into Bitcoin. Now, again, on what basis? Why is that good for you? What's your objective? Why would you throw all your money into something you know very little about and you have very little control over? So I think while our answers might not come as a definitive, it is all about listening to what you want, what you need to achieve.
And asking the right questions of the right people at the right time. So in essence, if I was to put that into a paraphrase to move on to the next part of our podcast, smart habits with the right information.
Oh, I like that.
I like that. I'm going to use that from our website.
I'm now thinking I'd got in my head what was going to be next.
Just quote him, so you don't get in trouble.
So, what are some common tax myths that business owners often believe? So, this is now not necessarily about the advice. This is those myths from the man down the pub and his dog and whoever else. If we can challenge some of those assumptions of whether it is actually absolutely not, or yes with advice, or you can do that technically without advice, because let's be perfectly honest, some people are savvy enough and will make some decisions themselves, whether they are right or wrong. So let's position it with what myths do you come across regularly around that whole tax planning piece?
Okay. First one, clients always seem to assume their accountant is always looking at their books, as if the accountant has time every week to be keeping an eye on everything they're doing. and just
What do
assume
you mean they don't?
and just assume if something pops up, then immediately contact them.
Yeah.
I come across all the time. It's like, no, touch base. Do you actually have regular monthly meetings with your accountant to discuss the business, what it's doing, and things like that? That's the one I come across the most. Is that one where they just assume their accountant's looking at everything.
Yeah, that's
we've all got a lot of clients to deal with. It's hard to just focus on that one all the time.
Well, I think I touched on it earlier, the myth of just throwing £60,000 in for the sake of throwing £60,000 in because it's going to get me £15,000 corporation tax relief.
Yeah.
Well, do you have that bill first and foremost? Because is it going to be worth doing it in that same...
Yeah.
You know, if it's just for tax relief, is it worth doing it for that reason? And the other one is the amount of products people believe they can put through the business. So a lot of insurances that they can put through the business that will be an allowable expense, which just unfortunately aren't. There was one years ago about critical illness cover, one of the biggest providers. I won't name them because, of course,
you're independent.
Very close there. Very close. But again, because critical illness is not really that allowable benefit, people were sort of looking towards that type of cover as something they could put as an allowable expense. So it's just, again, not believing all the hype, checking the information with your accountant, checking it with your IFA.
Yeah.
Because otherwise, you could fall into a trap very easily.
The old wholly and exclusively.
Absolutely.
So is there a difference between, and I think I've probably teetered on the compliance piece, but is there a difference between compliance and forward-looking tax planning? Or are they one of the same?
To be fair, that question went over my head.
I think look, compliance are there to make sure no one falls foul. So I think they do probably work together quite nicely. Again, I have a team that work behind me that sort of make sure the advice that we're giving to clients is fully checked, is fully appropriate, and on top of all of the current regulations that we work within. So I believe compliance and that go together.
Yeah, and you can only work on now sort of thing, can't you? What is the legislation now to plan for? Obviously, things may change. I mean,
I have
pensions are part of IHT. That was a massive one where years ago it was always an additional.
Yeah, and I guess that's where I kind of thought, actually, that forward tax planning, how do I plan to reduce that IHT potential burden? Well, that now, from a compliance perspective, has completely pivoted because rules and regulations change. And that kind of compliance alongside tax planning, that whilst they're inextricably linked, one will tend to drive the other and vice versa. It's kind of that vicious loop. I kind of get that you can't do tax planning without an understanding of the compliance and the implications behind it.
Yeah.
So never take the advice of the man down the pub who's probably plastered by now because we referred back to him that often, and actually get the right advice at the right times.
But just to add to that as well, I think the carefulness is, obviously tax changes do happen quite often, as we've learned with the last few budgets, and the amount of panic that comes out these budgets is quite phenomenal now. So we always talk about how tax year end can be quite busy. I think the 2 weeks before a budget seems to be as busy now as tax year end, because a lot of clients panic about whether to use tax-free allowances, whether to maximise pension planning, whether to take their tax-free cash, for example. So it is, we're going to use compliance, we're going to use the rules that we work within, because that is what we have to use. We can't be speculative on what a future government proposal might be. We would all love inheritance tax thresholds to be much higher. We would all love to be able to put more into our pensions. But we can't work off the assumption that will happen or won't happen. We have to just take what we've got right now.
Now, I believe that you're going to be able to answer this question quite comfortably without any compliance issues.
Now I kind of hope we can't.
Is there an income level where actually I should be talking to an IFA about my future tax position? Is there an income level that you go, actually, you must do it at that level, or can you start any time?
I mean, any can. I would definitely say clients that are around that 125 really, and above. They really need to be for the main reason that whole 60% trap they normally call it, that is a massive issue.
But ultimately, you don't turn away a client that's got maybe £5,000 to look at putting into an ISA, as an example.
No, and I think tax is relative to the individual, and planning is also relative to that individual. That a lot of businesses will run off the lower salary dividend model, so we have to work within that.
Yeah.
The £100,000 tax trap, and I'll use that official terminology, because a lot of people are unaware of the benefits of then investing to try and get themselves back into a positive position with the personal allowance. So anyone really would benefit from advice, but there are some key elements for each section.
So for clarity, when you reach £100,000, what happens to your personal allowance for the viewers?
I don't know. Are we allowed to answer?
I was trying to work out if I do a noise.
Caveat: no tax advice.
Yeah.
The higher it starts to go, the lower your personal allowance. So while you do get the 12,570, if you're over 100,000, it then starts teetering down.
So, and that's not tax advice. That's what it is. And I just wanted to hit that because you've both mentioned those 6-figure salary positions, and I wanted for people to understand what that actually means for them in
it's
terms
something
of
that everyone should be educated on, like you said, about education. But a lot of people just don't know.
It's been around. I can't remember the year it was first bought in, but it has been around, certainly around the 10-year mark, maybe longer. And a lot of people fall foul of it. And of course, as earnings have increased, as people are earning more money, more people are getting trapped by it. And the personal allowance has been 12,570 for some time. So it does feel like forever. So, if you go over 125,000 pounds, there is a potential you would have lost your personal allowance.
So just giving away £12,500.
Child benefit, all those type of things. The amount of clients I've come across in the past where they were receiving child benefit, but there was no education on their income and everything. Years down the line, they've just gone and got a massive bill because it's like, right, you owe us all that child benefit back now.
So to give you an example of child benefit, so I was getting hit by the tax charge where my wife just thought she was getting the child benefit. So again, it is that lack of knowledge that one partner is probably getting hit by a child benefit charge along the line.
So and I'm just going to pick that up because I don't think we've really covered it. So if you're in a couple, is it beneficial to meet an IFA together rather than individually?
100% always, as a couple is always better,
Perfect. So
you've
answered something.
Probably get in trouble for it now.
Unanimously.
The amount of times where you would meet an individual of a couple, and when you actually sit down with both of them, they both have different plans, but they've just never sat down and discussed what's important to both of them. So it's always better.
And there's allowances.
Marriage counselling around finances.
I don't allow any arguing.
Well, again,
but
but it's quite funny, and I'm smiling because a client meeting recently, they were talking about the purpose of getting married to help inheritance tax planning.
Okay.
So again, meeting a couple is vital because there might be things we can discuss. Don't get me wrong, we do not give marital advice and we do not give personal relationship advice. But if you've got two people that are sort of contributing to a household, there are probably allowances we can use across the board.
Okay. So I think we've touched.
To be fair, we can end it there. We've answered a question.
So how common do you find the "I'll deal with it later"? So we're not asking you about any of the advice, but how often do you come across people that go, "I'll deal with it later"?
How ironic the month we're in. How ironic. March, by the way.
Thanks. Our Timeless podcast just disappeared. No, it's fine. Is it?
I don't want to give a specific number, but
is it a common thing that when you meet with people, maybe if I spin that slightly and go, I wish I'd have done it earlier rather than I'll deal with it later.
It's not even that. I mean, you do get some like new clients that will come along wishing they did it sooner, but then you do also get some where you would have met them beginning of the tax year, plan things out, but work, things like that, holidays have all got in the way that they have kind of left it last minute. So you do have to keep on top with them.
I think market events, I can pick a couple of recent examples where market events made, decide to postpone a decision because they're panicking about the market. even though the objective might still be there and actually the benefit is still there, the market might dictate that we're not going to do it right now. Constant tax changes. There's a lot of clients around that budget time that might delay now and postpone that decision, even though it might not happen. And a lot of my clients will probably say, "I wish we'd done that sooner," but that's the benefit of hindsight, of course.
It is absolutely, which probably brings us nicely into kind of rounding up this part. Are missed opportunities a bigger issue than actually making mistakes when it comes to tax? So that's not from you advising, because obviously you can only advise what's there, but from a client perspective, missed opportunities, markets and all of that, do they actually become a bigger issue for them than making a mistake and doing something and then something else happening, a market crash or something?
Again, I think I would rather clients sort of, try to plan correctly throughout the course of the year. There are some tax allowances that are lost. So if you don't pay your £20,000 into an ISA, you can't come back and do that. Whereas, Dan touched on it earlier, if you don't pay all your money into a pension, there still is an opportunity using the carry forward allowances you can use. So for me, yes, there are probably some products that you would want the client to maximise where possible. But it does all come back down to circumstance. There might be a valid reason why someone can't pay their 20,000 into an ISA. There might be a reason that they can't fund the pension that particular year. It all does come down to a circumstance. But in terms of, I'm not quite sure on the mistake part there, Paul. But I think if people invest and people do the right things using the tax allowances available to them, I do believe over time it would iron itself out anyway.
So I guess then just to sum it up, it actually isn't what people are doing wrong, it's what they're not doing at all that gives you guys the biggest challenge, but actually in some cases the biggest opportunity to make a difference. Right. So let's bring it all back together with a little bit of timing, because everything we've talked about seems to come back to when you start and if it's right for you. And I think you've kind of alluded to this, but actually, when is the right time to start? And is there such thing as starting at the wrong time?
I'm going to use a phrase I used to always hate when people said it to me. When I said, "When do you want something done?" And then it'd be like, "Yesterday." I used to hate that phrase so much. But it's actually appropriate. As soon as possible. It doesn't... People always assume they've got to have a lump of sum of money to invest, or they have to actually have a business. Just speak to an advisor. Just have that conversation. If we find that we're not useful, we'll be honest and say. But as soon as possible. It's the same with an accountant. Just have that conversation with them.
And so the earlier the planning, does that afford them more opportunity?
100%,
their position will be increased if they start their planning earlier. Obviously, they'll have bigger pension pots. They might have the protections at the lower cost because it is based on life and health and timing again. They will benefit from potentially longer time in the market. So the more they can do earlier, the better. It's never too late, I suppose. There's some arguments it might be too late, but it's never too late to do something that could be positive towards your planning.
Absolutely. And this is a little bit compliancy, and it's probably more from experience than anything. If we look at where our world is right now, and to use your analogy, it's constantly up and down. If someone's looking to invest, is it about actually being prepared to invest for a longer term because of the way the market may go up and down during that investment? And if people are looking for potentially quick wins, some types of investment are not right for them for quick returns.
Have you ever read that before? Where a client says, "I want to get rich quick"?
No,
I used to come across that a lot in the early days, and it was like, huh?
I think back in the day, because I'm 20 years into the profession, so back in the day maybe, but I think clients are a little bit more aware of what they're coming to see when they come to see a financial advisor. They are probably aware that money is likely to want to be put away for a period of time.
Yeah.
And it will get the best return over time. Don't get me wrong, if you invested this time last year, you would probably have made quite a lot of money based on market performance.
Yeah.
But we don't know that going into it, so we always try and hold on to it as long as we can. And again, you go back to compounding, all the things you spoke about earlier. There's obviously benefits for long-term investing.
Yeah, fabulous. I've just got one little bit, and it is more just about you guys being able to say, within the boundaries, the thresholds that people can do into things like your ISA, a stocks and shares ISA, because those are just publicly available. But I just think it's worth them coming out of your voices or your mouths rather than actually them taking that TikTok influence and says, yeah, you can do all of this. So can we just run through what some of those, and I know this doesn't mean this podcast can be time dependent, but what those thresholds are. Let's go for the forthcoming tax year, because we know there's a few bits that are changing. So reel them off, boys. Reel them off.
Well, there's so many. I don't know where to start. I don't know which way.
ISA allowance.
So ISA allowance, so stocks and shares and cash ISA allowance for the next tax year. I'm just thinking about that. So for the next tax year is £20,000. But I will sort of just come in there and say Rachel Reeves has announced plans to reduce the cash element of that to £12,000. And then obviously you still would be able to put the other 8 into a stocks and shares if you wanted to go down that route.
Wow. Okie doke. What else?
What we're talking about, just the allowances.
The allowances that somebody, general allowances someone's got. We know that 12,570.
Personal savings allowance is always a big one.
Yeah,
that's one I'm coming across a lot with clients now, where you could quite easily go into a bank, put a lump of. Oh, I'm panicking about client compliance now. Jeez. we'll go with it and we'll see what happens. When you go into a bank, you'll literally say, "Okay, I've got 20,000 to invest." The bank can't give financial advice.
Yeah.
They're not going to say, "Oh, you're better off putting it in an ISA because it's tax free."
Yeah.
They'll go to you and go, "Oh, look at this ISA that has this fancy rate. However, look at this fixed rate bond that has an even higher rate. Why don't you go for this?" And a client will go for that, not realising it's not tax free.
Yeah.
And it's all dependent on their £1,000 or £500 if they're a higher rate taxpayer, their personal savings allowance.
Right. Okay.
So you have up to £1,000 a year.
Yeah.
On that as well. And the amount of times I've come across clients where it's like, actually, you need to talk to your accountant because you've made a lot more than that £1,000.
Yeah,
so
and it affects the tax code the following year. So a lot of my clients who are pensioners are being affected by that because they've got to get that tax back from somewhere. The bank will report to HMRC how much interest that client has earned. And they've got to make an adjustment somewhere down the line. Wow. They've got to look at where they can get it. And that £1,000 becomes £500 if you're a high rate taxpayer. So again, if you earn a bit more, you get less of that allowance.
Yeah, that was one I never had to look out for that much. But as the years have gone on, it's a conversation I'm always having to make
people becoming more savvy with their money and hanging on to it for a little bit longer.
Again, we were at 0.5% as a base rate for so long in this country that, the savings conversation was very rare to have that someone breached these allowances. Because, you would have had to invest a lot into cash saving. So it's a one to watch out for. Obviously, the standard allowance is 12,570 is your personal allowance. The high rate is 50,270. They have been the same for, as you alluded to, forever.
Feels like forever.
It does feel like it's been forever. They've not changed.
And the pension contribution is £60,000, but there are some caveats to that. You have to be earning up to £60,000 to get the full allowance of that, and that is for tax relief. So just obviously that's your annual allowance. And inheritance tax, that seems like it's been this forever, £325,000. I think 2009 maybe when it got to that figure. So
lots of numbers floating around that we just need to be mindful of for those that actually don't want to engage with that professional support, let's call it.
Yeah.
So we're going to wrap this up with 2 questions, one for each of you. Okay. So we'll hit Rob first, not literally, even though he's been a bit of a politician today.
Hands coming through.
Rob, how does working with an IFA help align business income and personal financial goals?
Well, I think again, it marries up the objectives. So as a business owner, you're probably wearing the two hats anyway. How do I make my business successful, and how do I make that profitable, and how do I extract that profit out for me personally? So I think that meeting will help us decide how we do that best. On a personal front, then we have your personal allowances to work with, your personal ambitions, your family, all of the things that are important to you for your potential retirement, for your mortgage repayment. So I think that meeting is key. We will ask a lot of questions unashamedly, because we really want to get to know you before we give you the best advice we can.
No, perfect. And then Dan, just to round this out.
Hit me.
Not literally. For some listening and tuning in today, what's the advantage of starting now rather than waiting and doing it later?
Your cash flow, I was going to say, is a massive benefit the quicker you start, the sooner you start, rather than leaving things last minute. Cash flow is that taking that time to fully plan where you are now, where you want to be in the future, what allowances, tax, things like that, what we then got on hand and to dispose of to then use moving forward as well.
Brilliant. So apart from the laughs and the jokes and me trying to get you to step over that compliance line, I think the general message coming across is actually good planning needs to start early with the right questions and the right conversations, but with the right trusted partners. The earlier you start, the better you are going to be looked after, both now and financially in the future. And that's it for this episode of Giving You More Than Numbers. Thanks so much to Rob and Dan for helping us talk about tax without rousing anybody's blood pressure or causing compliance issues. Make sure that you schedule your tax planning meeting with your accountant and your own financial advisor straight away, not when it's too late. If this episode helped you feel calmer about tax, like, subscribe, and leave a review. It genuinely helps other business owners find the podcast. Thanks for listening, and we'll see you next time on Giving You More Than Numbers.